Hello traders, join us in this video where we will be discussing some of the aspects that traders have to factor when they are trading the Australian dollar versus the United States dollar currency pair. We'd like to begin by outlining that when trading this currency pair, it is essential to first grasp the significance of both the Australian dollar and the United States dollar within their respective economies. At the same time, it's important to note that these currencies are not only pivotal in their domestic markets, but also carry global influence due to the economic roles that Australia and the United States play. Typically, understanding the macroeconomic factors and market dynamics behind these currencies is a critical starting point for every Forex trader, and particularly when they are trading this currency pair. The Australian dollar is often considered a commodity currency. And this is because Australia's rich natural resources and its status as a leading global exporter of raw materials, some of which include iron ore, coal, and natural gas, among others. The Australian economy is closely tied to global demand for these commodities, particularly from key trading partners, which include China. As such, this commodity-centric economy means that Australian dollar versus United States dollar traders need to closely monitor global commodity prices, particularly metals and energy, since they can significantly impact the value of the Australian dollar. On the other hand, United States dollar holds the status of the world's primary reserve currency and is often or is used as a benchmark in global trade. We also have to mention that the United States economy is highly diversified, with significant contributions from sectors which include technology, finance, manufacturing, and services, among others. As a result, the United States dollar is influenced by a broad range of macroeconomic indicators, some of which include Federal Reserve policies, interest rate decisions, inflation reports, and employment data, among others. It follows that traders of this currency pair need to keep a keen eye on the US economic data releases, as the dollar's strength or weakness is often tied to these metrics. We have to mention that while both the Australian dollar and United States dollar have global influence, their behavior in forex market differs due to varying economic structures, central bank policies, and risk sentiment. The Australian dollar tends to be more volatile and is often viewed as a risk-on currency, meaning that it is generally strengthens when investor sentiment is optimistic. On the other hand, the US dollar is considered a safe haven currency, often gaining strength during periods of economic uncertainty and also during times of geopolitical tensions. This fundamental difference creates opportunities for traders to capitalize on sentiment-driven movements in this currency pair. One key correlation to understand when trading the Australian dollar versus the United States dollar is its link to global risk sentiment. Due to its reliance on commodity prices and close ties with China, the Australian dollar often benefits from positive global growth prospects, which is particularly true when China's economy is strong or is becoming stronger. Conversely, when global risk appetite declines, perhaps due to fears of economic slowdown or rising geopolitical tensions, the Australian dollar typically weakens as investors seek safety in the United States dollar. These relationships makes the Australian dollar versus the United States dollar currency pair sensitive to broader macroeconomic events beyond just bilateral relationship between the two countries. Another important correlation is the relationship between the Australian dollar versus United States dollar and commodity prices, particularly that of iron ore, gold, and oil. Since these commodities are major exports for Australia, changes in their prices can directly impact the Australian dollar. For instance, a surge in iron ore prices due to increased demand from China could strengthen the Australian dollar, while a decline in global commodity prices could weigh on the currency. It follows that market participants must stay informed about developments in the global commodity market and factor this into the Australian dollar versus United States dollar trading strategies. Interest rate differentials is another thing that traders have to factor as they trade this currency pair. Interest rate differentials between the Reserve Bank of Australia and the United States Federal Reserve also play a crucial role in determining the direction of this currency pair. Generally, when the Reserve Bank of Australia raises interest rates relative to the Fed, the Australian dollar tends to appreciate against the United States dollar, and this is because higher interest rates attract foreign capital seeking higher yields. Conversely, when the Fed tightens monetary policy while the Reserve Bank of Australia maintains cut rates, the United States dollar tends to strengthen against the Australian dollar. As such, monitoring central bank policy statements and fund guidance is, therefore, a critical factor that traders have to practice as they engage or they anticipate future movements in interest rate differentials, which can drive the currency pair in one direction or the other. Given the fundamental dynamics of the Australian dollar versus the US dollar currency pair, traders should consider several strategies to capitalize on its fluctuations or its movements. One popular approach is trend following, which typically involves identifying and trending longer-term trends in this currency pair. Since the Australian dollar versus the US dollar can exhibit prolonged trends based on commodity cycles or macroeconomic development, trend following strategies can be particularly effective. Traders can use technical indicators including moving averages or trend lines so as to identify entry and exit points. Another effective strategy is the carry trade, which exploits the interest rate differentials between the Australian dollar and the United States dollar. When the Reserve Bank of Australia offers higher interest rates than the Fed, traders can profit by borrowing United States dollar at lower rates and investing in Australian dollar so as to earn interest rate spread. The carry trade is particularly appealing in stable or low volatility environments where the currency pair is not subject to sudden swings that could erode the gains from the interest rate differential. However, traders must be cautious as carry trends can quickly unravel during periods of market turbulence, which often leads to sharp currency movements that can wipe out profits and lead to huge losses. For those traders that are seeking more short-term approach, range trading can be an effective strategy for this pair, particularly during periods of consolidation when the currency pair is not trading strongly in either direction. Range traders seek to capitalize on price fluctuations within undefined support and resistance level, buying near support and selling near resistance levels. Sorry. In the context of Australian dollar, these ranges can form during periods of economic uncertainty when neither the Australia nor the US economies are showing clear direction or clear momentum. It is vital to take note that risk management is critical when trading this currency pair, just as with other currency pair. And this is because there is potential for volatility in this currency pair due to shifts in global risk sentiment, commodity prices, and interest rate expectations. As such, setting stop losses to protect against adverse price movements is essential. At the same time, traders have to maintain a disciplined approach to position sizing as they trade this currency pair. We also have to mention that traders should always remain flexible and willing to adapt their strategies as new economic data emerges or market conditions change. In addition to these strategies that we have outlined, traders should consider the role of geopolitical events and trade policies that could affect the Australian dollar versus the United States dollar currency pair as they trade the forex markets. For instance, a trade tension between the United States and China could weigh on the Australian dollar due to Australia's heavy reliance on Chinese demand for its commodities. Conversely, favorable trade agreements or economic cooperation between Australia and its key partners could support the Australian dollar. Traders therefore need to stay informed about geopolitical development and assess how this could impact the currency pair, particularly when they are trading it. A critical aspect factor is the art of deploying a combination of technical analysis and fundamental analysis when trading this currency pair and also other currency pair. Typically, combining technical analysis with a solid understanding of fundamental drivers of the Australian dollar versus the United States dollar or the Forex market can give traders a more comprehensive view of the market and improve their chances of making profitable trades. We'd like to finalize on a note. You, all traders, must always remember to trade wisely. Thank you for watching, and let us interact again in our next trading video.